How does IV affect your portfolio, and what strategies can you use for specific IV conditions in the market? This is what we're going to be covering in today's video. First of all, what does IV mean? Well, IV stands for implied volatility, and IV just measures the market's future expectations of where volatility will be. So how much the market will move in the future. So this can be 7 days, 30 days, 90 days, 180 days, whatever it is. But you usually find just the IV number. So this IV number is an expectation for the future. It is kind of like a barometer, but not for temperature, but for movement in the market. So the higher the IV, the more movement is expected in the future. And the lower the IV, the less movement is expected from the markets in the near future. So why does IV matter, even outside of crypto options? Why is IV important? Well, outside of options is because that gives you an idea or an understanding of market conditions. If the market is going to be choppy, it's going to be moving a lot. If it's going to be sideways, you can understand that by IV. You can use that with other indicators to make your strategy for not only crypto options. But for crypto options, IV matters a lot because it affects directly the pricing of the options, the premium of the options. They're affected due to IV movement. So understanding IV makes you a smarter trader and makes you do better entries and exits. So IV makes for a part of the intrinsic value of an option. So each options, they can have intrinsic and extrinsic values. I covered this briefly in another video, but basically inside intrinsic value, IV is part of that amount of things that make the premium pricier, so make the options pricier, which is good when you're a seller and not so good when you're a buyer, because you're going to be spending a little bit more to open the position. So with that in mind, how can you profit with IV throughout different scenarios? So rising IV, IV going down, sideways IV, how can you profit from these three? Well, let's start with a rising IV scenario. When IV is rising, the premium is increasing in price. So let's say you have an option and the premium is $10. If IV was 50% back then, when it goes to 60, 70, 80, that 10 bucks that you paid will be higher and higher exponentially. So if you bought an option at low IV and it rises, that is great news for you because the premium itself will inflate. It is kind of like a balloon. So you bought a balloon and someone just blew inside a balloon and now the balloon is even bigger, it's larger. So your premium, your option will be costlier, which if you bought it at cheap, you wanted to sell it at a higher price. So if you get direction right and IV goes up, your option will increase in size by a lot. That it is not so good for selling options, because if you sold an option and instead of going down in value, it goes up in value, when you buy it back to close the position, you will have to pay more than what you received from. So you're going to be in a net loss. So you don't want that to happen. But even if you sold at low IV and IV goes up, if you get the direction right, by expiration, you should be fine, because theta will also help you out by eating away the pricing of this option. Theta is the time decay. We covered that in another video, but if you want me to talk just about time decay in a single video, just let me know in the comments below. So what is a good strategy that you can have for a rising IV scenario? Well, it doesn't get simpler than that. You can just buy calls or puts. So if you believe we're going to have an increasing IV scenario, but it is going to be a huge movement on the downside. So you believe Bitcoin or Ethereum, for example, is going to go from 3K all the way down to 2,500. This will for sure create a huge spike in IV. But the spike in IV will be positive, the number will be growing, but a spike in IV does not tell you the direction. So if you believe it's going to be a huge movement on the downside, you buy puts. If you believe it's going to be a huge movement on an upside, you buy calls. So you buy it and you wait for the IV to go up, or you wait for the IV to increase even more. So you see IV increasing, you buy it, and then it increases more. This is where you make money, especially if you get the direction right. So for buying options, very, very simple. You go to betopics.io. It's going to be the first link in the description. And here you choose the expiration, meaning that until when this option will be valid. So you can go May 19th, you can go all the way to next year. So March 2025, whatever it is. Let's go to the 21st. And here you select the strike. This is kind of the place that you want it to be above or below, depending if you're going for calls or puts. If you want to go for a call, you want it to be above the strike. And if you're going for a put, you want it to be below the strike. But basically this sets the limit to where the underlying asset needs to go over this limit for you to be profitable. Actually, it needs to go over the break even, but you can only see the break even once you have the strike selected. So let's go for, now Bitcoin is at 67, let's go to a 64. So that actually means that if Bitcoin is above 64,000, actually a little bit more because there's a break even. So let's say 65,000 by May 21st, I will be making a profit out of this, because again, I will pay $436 out of my pocket to open this position, because I'm going to be open 0.1 of a contract. And then the IV, the more it rises, even if Bitcoin stays the same price, even if Bitcoin doesn't move, because IV is rising, that 436, it can become 500, 600, 700, because IV will be making part of the intrinsic value of the option itself. So even if Bitcoin doesn't move, this is the funny thing, even if Bitcoin doesn't move, just because IV is spiking, because people believe that eventually Bitcoin will move a lot, then this option itself will be favorable for me. And you can do the same thing with puts, just the reverse. You want it to go below the strike that you choose, and again, below the break even that you choose, and you want the underlying asset to move as fast as possible, or IV to just keep on rising, because again, the premium will be juicier, will be higher. So if you buy at 10 and you sell at 20, you will have the $10 profit for the contract itself. So what about IV going down? This is very, very common on stock options. The term is IV crush. A lot of people buy option or sell options, and they even get direction right, but they lose money. This is because they get IV crushed. What does that mean? It means that they bought at a high IV or they sold at a high IV, and the IV drained. So the market kind of stagnated, or it just didn't go as they wanted it to go. It didn't move as much as you wanted to go, or it moved a lot slower than everyone thought it was going to move. And that made sure that the IV itself, so the intrinsic value of the option, dried out. So that usually takes a huge beating on options traders. This is why on a high IV scenario, what you usually should do is selling options. So selling options is great for high IV scenarios because you're getting juicy premiums. You're getting like the sweet nectar of the gods. And I personally have been doing that for 2 years, almost 3 years now. And we've covered a lot here in this channel. And usually when IV was like above 80, above 90 for Bitcoin, this is where we were making 3, 4, 5% per week on very, very low delta options. So we were selling 7, 8, 10 delta options, and we were making 2, 3, 4% on these options weekly. And these were amazing times. Of course, we haven't seen a huge IV like that for a long period of time. We've seen IV spikes here and there for Bitcoin and for Ethereum, but nothing like that as we saw a few years ago. So a good strategy for you to do before an IV crush is to sell options or to have credit spreads, because again, you're collecting premium, so you're collecting capital, and then you have to close the position before expiration, so you want it to be lower than what you received it for. Well, what about the sideways IV? A sideways IV means that people don't think the market will be fluctuating a lot. There won't be a lot of movement in a short span of time. Flat IV does not mean flat markets. It means just that it won't have drastic movements. It can be bullish, it can be bearish, it can be sideways. But again, flat IV does not mean flat markets. But on flat IV scenarios, you can jump to the conclusion that the markets won't rush towards the side. If they are bullish, they will still keep that slow and steady growth. If they're bearish, it will be the slow and steady decline, or it will be a sideways market as a whole. Again, flat IV does not mean that it's going to be a flat market, because a lot of people get it wrong, thinking that flat IV means there will be no movement in the market. It can be choppy market, so it can be going up and down inside a range that will show as a sideways IV numbers. It can be 60 today, 50 tomorrow, 60 again, and so on and so forth. And this doesn't mean that the market is going to be going sideways. So a sideways IV would be for you to, again, do spreads, do credit spreads, or do iron condors if your protocol allows you to do so. Because again, you're defining a range where Bitcoin or the underlying asset will stay inside. So for an iron condor, you sell 2 OTM options that will define the range itself of the strategy. So if you define a range between $60,000 and $70,000, this will be your iron condor. And if Bitcoin stays inside that range until the expiration time of the option of the strategy, then you profit it. Or you can do similar things with a vertical spread by predicting where it won't be in a certain period of time. Or you can use two vertical spreads to create something similar to an iron condor. So you do a call spread and a put spread, and this will kind of generate a similar P&L of an iron condor. And this will allow you to profit from stable income, just like a passive income sort of scenario, when there's limited price movements from the underlying asset. So Bitcoin doesn't need to go crazy, doesn't need to do anything, just stay chill. If it's going down, it keeps going down at a slow, steady pace. If it is going up, it can go up at a slow, steady pace, as long as this respects the strikes that you choose, the limitations that you pose for this strategy. And for spreads, for the spread strategy that you can use for sideways market or IV crush, doesn't matter. You can go for put spreads or call spreads. If you don't know which one to choose, we've made a video about vertical spreads, when to use each and every spreads. So check that out to understand. But here you can define which one you want by looking at the strike. So if you want to above a certain threshold, you're going to go for these green ones. And if you want to go below certain threshold, then you're going to go for these red ones right here, orange, red, whatever it is. So depending on your understanding of where the market won't be, so Bitcoin right now is at 67,000. So will it be below 62 by end of May? Oh, I don't believe we'll be nearly close at 62. So this option right here doesn't make sense for me because I don't believe Bitcoin will be below 62,000. But let's say I do believe that Bitcoin will be above 65,000. I believe Bitcoin will be at 70,000, or it will stay at 67, or it will go at 68 by end of the month. Then this one right here is good for me because I do believe that Bitcoin will stay above 65,000. So I open this right here. It is very simple. You click the amount of US dollars that you want. This makes it a little bit easier. Instead of you having to calculate contracts, how many you have to go, you just put how many dollars you want to put. So if I put 500 bucks right here, I know that I will make a maximum profit of $78.50. So we made sure this is very, very simple for the user. So the user doesn't have to worry about understanding sizes. He just needs to understand where he thinks the market will be or where he thinks the market won't be, and open a position with the amount of dollars that they want. So understanding IV is very important for you to master and to control in the best way possible your portfolio. Of course, trading IV, selling high IV, selling options, it takes a little bit more to make money than for you to buy options and speculate on an asset, because the passive side of things always takes a little bit more to be profitable than the active side of things. So for me, I like passive income, and this is why I sell options more than I buy options, because I believe in a slow and steady growth with my portfolio. So this is what I do with my personal capital. But again, with a good understanding of IV, you can be a good speculator because you will be more prominent into riding IV waves, you know, so high IV, you ride it all the way up and you profit from a growth in premiums as well. So this is really, really good for you to know. So comment down below, what is your favorite strategy out of these three? If you prefer rising IV scenarios, lower IV scenarios, so IV crush scenarios, or you like a slow and steady IV, sideways IV market. Let me know down in the comments. And again, thank you so much for watching. If you have any questions, leave them down below, and I'll catch you guys in the next video. See you.